Welcome, ladies and gentlemen, to another edition of Accounting 101 made simple by J Ham. Today's topics we will be discussing non-current assets on the balance sheet. As discussed in the previous video lesson, non-current or long-term assets are assets the company owns that have a lifespan of more than 12 months or one accounting period. Some examples of non-current or long-term assets are buildings, equipment, furniture, and various types of vehicles, such as cars, vans, and trucks. Non-current assets in detail. We'll start with buildings. Buildings is a fixed asset account that contains the carrying amount of buildings owned by the company. The carrying amount is the original purchase price, plus later capitalized additions, minus accumulated depreciation and any asset impairment. It's very critical for you to understand the calculation for the carrying amount of the non-current asset. So I want to go over it one more time with you. The carrying amount is the original purchase price plus later capitalized additions minus the accumulated depreciation related to that building and any asset impairments, which is a write-off or a write-down of the asset to its actual value. We'll discuss that later on in this video. Unlike land, the buildings are subject to depreciation or the periodic reduction of value in an asset that is an expense on the income statement and reduces income ultimately. We'll discuss this more in depth in a later video lesson. So for example, if a company owns two buildings, one for $500,000 and one for $400,000, the company would record a total of $900,000, which is the $400,000 plus the $500,000 in the buildings account, which is reported on the balance sheet of the company. Moving on to equipment. Equipment is another fixed asset account that contains the carrying amount of the total equipment owned by the company. Just like the buildings account previously mentioned, the carrying amount of the equipment is the original purchase price, plus later capitalized additions, minus accumulated depreciation, and any asset impairment. Like buildings, the equipment is also subject to depreciation or the periodic reduction of value in the asset that is an expense on the income statement and reduces income. Some examples of what a company would classify as equipment are computers, telephone systems within the office, copiers, fax machines, and other electrical gear. So for example, if a company buys 10 computers for $30,000 and installs a telephone system for $50,000, the company would report a total of $80,000, which is the $30,000 for the computer plus the $50,000 for the telephone system, and that would be reported on the company's balance sheet as equipment. Furniture. Furniture is a fixed asset account, just like the equipment in the buildings, that contains the carrying amount of the total furniture owned by the company. Just like buildings and equipment previously mentioned, the carrying amount of furniture is again the original purchase price of the furniture plus later capitalized additions to the furniture minus accumulated depreciation of the furniture and any asset impairment of the furniture. Like buildings and equipment, furniture is also subject to depreciation, which is the periodic reduction of value in the asset that is an expense on the income statement. It's actually called depreciation expense, and it reduces the company's income for the period. Again, we'll discuss this more in depth in a later video lesson. Some examples of what a company would classify as furniture are cars, tables, conference tables, desks, and cabinets. For example, if a company buys 20 chairs for $10,000 and a conference room table for $25,000 for its office, the company will report a total of $35,000, which is the $10,000 for the chairs plus the $25,000 for the conference room table, on the company's balance sheet as furniture. Now we'll go and discuss the vehicles: vans, cars, trucks, collectively vehicles. Vehicles is a fixed asset account that contains the carrying amount of the total vehicles owned by the company. Just like the buildings, equipment, and furniture accounts previously mentioned, the carrying amount of vehicles is the original purchase price plus later capitalized additions minus accumulated depreciation and any asset impairment. And like buildings, equipment, and furniture, vehicles is also subject to depreciation, or the periodic reduction of value in the asset that is a depreciation expense on the income statement, which reduces the company's income. For example, if a company buys a fleet of 30 cars for $750,000 and also buys a delivery truck for $70,000, the company will report a total of $820,000, which is the $750,000 for the fleet of 30 cars plus the $70,000 for the delivery truck. And that $820,000 will be reported on the company's balance sheet as vehicles. Accumulated depreciation, Contra accounts. Accumulated depreciation is a fixed asset. Accumulated depreciation is a Contra account that is used to reduce the value of the related account when the two accounts are netted together. So let's say that again. Accumulated depreciation of fixed assets is a Contra account that is used to reduce the value of a related account when the two accounts are netted together. A Contra account's natural balance, and a natural balance is often referred to as the account's normal balance in the accounting industry. It is the opposite of the associated account. If a debit is a natural or normal balance recorded in the related account, the Contra account records the opposite, which is a credit. And we'll discuss debits and credits in detail in the later video lesson as we build up our financial statements from scratch. For an example, say if a company buys a building for $1 million on January 1st and has accumulated depreciation of the building for 1 year of $100,000 through December 31st. The company will report the net amount of the two accounts, which is $900,000. That's the $1 million for the building minus the accumulated depreciation of $100,000 for the building. The company would report that $900,000 on the balance sheet in the building's line item on December 31st. And I put as a side note, we'll discuss accumulated depreciation in detail in our video lesson covering the income statement and its related elements, because accumulated depreciation is directly related to depreciation expense. And as I previously mentioned, depreciation expense is an expense on the income statement of the company. Fixed asset impairment, or simply put, asset impairment. So at the end of every accounting period or at the end of every year, the company's management team is required by accounting principles generally accepted in the United States of America, or US GAAP, to assess its fixed assets for any asset impairments. An asset impairment is a reduction or a write-down of the fixed asset's carrying amount or value that is reported on the balance sheet to its fair value. Typically, this fair value can be obtained by a reliable third party who specializes in determining the fair market value of fixed assets, or it can be calculated internally by the team's the management team of the company. An asset impairment also results in an impairment loss that reduces the profit the company reports for the accounting period. However, it has no immediate impact on the company's cash balance. We will discuss impairment loss in a later video lesson when we discuss the income statement and its related elements. Problem time. Question number 1. Which of the following is an example of a non-current asset? A, cash, B, inventory, C, furniture, or D, prepaid expenses? Now remember that side note, as I always stress when we go over these questions, when solving multiple choice questions, always eliminate the obvious wrong answer to increase your odds of answering the question correctly. So let's start with cash, A. Which of the following is an example of a non-current asset? We know that cash is not a non-current asset because it's a current asset. So let's move to B, inventory. Inventory is an asset that's readily converted into cash within a 12-month period. So therefore, inventory is typically classified as a current asset. Now, what about D, prepaid expenses? Prepaid expenses is another current asset with the expectation of being utilized within a 12-month period. So we're left with C. And C is furniture, and that is considered a fixed asset or a non-current or long-term asset. So the answer to the question is C, furniture. Question number 2. Assets that a company owns that have a lifespan of more than one accounting period or 12 months are considered as which of the following? Current liabilities, A, B, current assets, C, non-current liabilities, or D, current liabilities. So we know that assets that a company owns that have a lifespan of greater than 12 months is always going to be a non-current asset. So the answer to question 2 would be D. Question number 3. Non-current assets are stated at which amount on a company's balance sheet? A, its fair market value amount. B, its cost amount. C, its carrying amount. D, its price quote amount. So let's do process of elimination to increase the odds of answering the question correctly. We know we didn't discuss that non-current or fixed assets, long-term assets, are carried on the balance sheet at its fair market value. It's only carried at its fair market value at the end of the year when you're reassessing, when the management team is reassessing the fixed assets for any impairment. So A is incorrect. B, its cost amount. Cost amount is incorrect because we didn't talk about non-current assets being stated at cost amount on the balance sheet. So the answer to the question would be C. Remember how we talked about C, the carrying amount of fixed assets or long-term assets is equivalent to the purchase price of the asset plus any capitalized additions minus any accumulated depreciation and minus any fixed asset impairment. So we know the answer to question 3 is C. And as we can see, the answer to the question is C, its carrying amount. So moving along to question number 4, what is the mathematical formula for calculating the carrying amount of a non-current or fixed asset? Now remember in our video lesson that we discussed that the carrying amount is always equivalent to the original purchase price plus capitalized additions minus accumulated depreciation minus asset impairment. So we know that the answer to question number 4 would be C. The original purchase price plus the capitalized additions minus the accumulated depreciation minus the asset impairment. Question number 5. A company purchases computers on January 1 for $36,000. During the course of the year, the company buys 2 additional computers for $6,000. Also during the course of the year, the computers accumulated depreciation in the amount of $14,000. On December 31st, the company's management team reassessed the value of its computers and determined that $3,000 of the computers were impaired. What is the carrying amount of the computers on December 31st? A, $28,000, B, $29,000, C, $30,000, and D, $25,000. Since you can't really do a process of elimination with these multiple choice, you will then have to plug these numbers in the formula, since you can't really do process of elimination to identify the correct answer. So again, what are we looking for? Always look at the very end of the question. Don't be intimidated by how large the question is, how big the question is. Look at the last couple of sentences or even the last sentence of the question to get the gist of what the question is really asking. What is the carrying amount of the company's computers on December 31st? So we want to know what the carrying amount of the computers are. That's basically what the gist of this question is. So let's set up our calculation for the carrying amount. So let's set up the carrying amount formula equation, which is the purchase price, as we discussed, plus capitalized additions, minus accumulated depreciation, and also minus any asset impairment. So if we plug these numbers in, from the question we knew that the purchase price was $36,000. Also from the question we knew that the capitalized addition, those 2 computers that the company brought during the year, was equivalent to $6,000. So we know that our capitalized additions portion of the equation is $6,000. Now let's move on to the accumulated depreciation portion of the equation. We know that the computers accumulated depreciation during the current year of $14,000. So we can plug that $14,000 into our equation. Last but certainly not least is the asset impairment. And from the question at the end of the year, we know that the company's management team reassessed the value of the fixed assets and determined that $3,000 worth of computers were impaired. So we plug that $3,000 into our equation as well. So we have $36,000 of the purchase price, $6,000 of the capitalized additions. We have $14,000 of the accumulated depreciation. And then we have finally the $3,000 for the asset impairment. So when we plug all of those numbers together, $36,000 plus $6,000 minus $14,000 and minus another $3,000 is $25,000, or D. So the correct answer to the question, the carrying amount of the computers that's going to be stated on the balance sheet at December 31st in this question would be $25,000. Question 6. Which of the following would classify as equipment? Which of the following would a company classify as equipment? A, conference room tables, B, trucks, C, cabinets, or D, computers. Always remember the side note. When solving multiple choice questions, always eliminate the obvious wrong answers to increase your odds of answering the question correctly. So let's begin with number 1. Is conference room tables considered equipment? A table would be, is a table a piece of equipment, or is a table a piece of furniture? No, a conference room table would be classified as what is furniture, and that's a different fixed asset category. Let's go on to B, trucks. Trucks is a type of vehicle. It's not an equipment. It's a vehicle type of fixed asset or non-current asset. So we know the answer is incorrect. Let's move on to C, cabinets. Cabinets, again, is more like A, which is conference room tables, which is furniture. A cabinet is a piece of furniture. Just think about your home or your apartment where you're living. You have cabinets there. That's really not equipment, that's furniture. So we're left with D, computers, and computers is a type of equipment. So we know the answer to question 6 is D, computers. Question 7. Which of the following fixed asset is never depreciated? A, buildings, B, equipment, C, furniture, and D, land. The answer to the question is always going to be D, land. Well, it's always going to be land because land is not a depreciable asset. Land doesn't depreciate. Furniture depreciates. Furniture breaks down. The more you sit on a chair, the more it's going to wear and tear, and the chair is going to break down. The more you use a piece of equipment, you keep using the equipment over and over and over again, it's going to wear down or depreciate, which is going to reduce the value of the equipment. Same with buildings. Buildings wear and tear down as well over time. So that would be considered a depreciable asset. However, land, the land on which your fixed asset stands, that never gets depreciated. So the answer to question 7 is land, which is D. Question number 8. Which of the following is the contra account for equipment? A, accumulated depreciation equipment, B, accumulated depreciation land, C, accumulated depreciation buildings, and D, accumulated depreciation furniture. So just by process of elimination, we know that answer B is incorrect because land doesn't get depreciated. So they won't have a contra account for land called accumulated depreciation. The other accounts will, equipment, building, and furniture, they all have contra accounts called accumulated depreciation. But because the question is referring to only equipment, we know that the correct answer to that question is A, which is accumulated depreciation equipment. Question number 9. A company buys a piece of land for $1 million. At the time of purchase, the company expects to liquidate or sell the land within 1 year. The land for $1 million will have which of the following balance sheet classifications? A, non-current asset, B, long-term asset, C, current asset, or D, current liability. Now, one would think that, okay, land, we just discussed land in this video lesson, and we know that land is a long-term or fixed asset. So we would select A, non-current asset. It's a non-current or a long-term asset. However, if we look at this question, we would understand that it's a trick question because if we look at the second sentence of the question, it states that at the time of purchase, the company expects to liquidate or sell the land within 1 year. Remember when we talked about classifications of current and non-current items? Non-current is what you expect to utilize or liquidate or pay off within a 12-month period. Long-term is what you expect to pay off or liquidate in a period of greater than 12 months or a year. But in this example, since the company expects to sell the land within 1 year, they expect to liquidate their asset in 1 year. And because they expect to liquidate or sell their asset in 1 year, they cannot classify that land as non-current asset. They will have to classify that land as a current asset because it's an asset that the company has where they expect to sell or liquidate into cash within a 12-month or 1 year period. So the answer to question 9 would be C, current assets. As I stated earlier, normally land is considered a fixed asset or a non-current asset. But because the company expects to sell or liquidate the land within 12 months or a year, it is stated as a current asset on the company's balance sheet in this case. Usually is long term. So if you see a question and they're referring to land, but they don't state anything about having anticipating selling the land or liquidating the land within a 12-month period, it always is non-current or long-term. So just keep that in mind. You really have to pay attention to these accounting questions because they like to throw a lot of curveballs at you. So you just got to be cognizant, read the question very carefully, and you'll be fine. So in the next video lesson, which is lesson number 4, we will be covering the following topic, which is current liabilities on the balance sheet part 1, accounts payable and accrued expenses. Ladies and gentlemen, if you like my work, please hit the like button on this video. Please subscribe to this channel. Please share this video on all of your social media, and please be sure to sign up to become a Patreon member to enjoy exclusive benefits such as one-on-one tutoring and one-on-one consultation and more in-depth accounting examinations to optimize your learning experience. May God bless you and see you in the next one.